Ever looked at a company's financial report, seen a healthy net income number, and thought, great, they're making money?
Happens all the time.
But then maybe this nagging question pops up. Where's the actual cash? You know,
Yeah.
why doesn't that profit number always seem to line up perfectly with what's in the bank account?
Yeah, it's a really common point of confusion. Bit of a financial mystery sometimes.
Exactly. And that's precisely what we're digging into today.
Big stuff.
Okay, let's unpack this. Today's deep dive is all about the statement of cash flows. Now, I know this one often gets a bad rap for being complex,
It can seem that way at first glance.
but honestly, it's one of the most revealing financial statements out there. Really tells a story.
Absolutely.
So our mission here, custom tailored for you, is to demystify it. We want to explain the core concepts and really show its incredible practical value. Understanding a company's true financial pulse.
And we're drawing this straight from a top accounting textbook, Kieso, Weygandt, and Warfield's Intermediate Accounting, 18th edition. Really solid foundation.
Right. Trying to equip you with that essential knowledge quickly and thoroughly.
Okay.
So let's start with the absolute basics. The statement of cash flows, it's one of the big four financial statements, right? Up there with the balance sheet, income statement.
And the statement of retained earnings. Yeah. It's fundamental.
But unlike those others, which, sometimes give you a picture based on estimates and accruals.
Which are necessary, but not the whole picture.
Right. This one cuts straight to the chase. It tracks the actual cash, money coming in, money going out.
It literally shows you where the money came from and where it went. No ambiguity there.
Think of it as like the ultimate reality check for a company's finances.
That's a great way to put it. Its main job is to lay out all the cash receipts, all the cash payments over a certain period.
And it's organized, right, into specific categories.
Yes, meticulously categorized into three vital areas: operating, investing, and financing activities. And, savvy users, investors, creditors, they really rely on this statement for some incredibly crucial reasons.
Okay, like what? Why is it so important?
Well, first, it's invaluable for assessing a company's ability to generate future cash flows.
Ah, okay. Future prediction.
Exactly. While net income tells you if a company made money on paper using accrual accounting.
Which involves estimates.
Right. The cash flow statement gives a more direct, often more accurate lens to predict future cash generation. It shows the actual fuel for growth.
So it's not just if they sold a lot, but if they can actually keep selling and funding operations.
Precisely. And that leads right into the second point: evaluating a company's ability to pay dividends and meet obligations.
Ah, the immediate stuff. Paying bills.
Exactly. Can they actually pay their employees, settle their debts, buy new assets, pay out dividends? The cash flow statement is your go-to for assessing that immediate liquidity and solvency. It's the ultimate measure of their financial flexibility, day-to-day survival, almost.
Okay, that makes sense. What else?
Third, and this circles back to that mystery you mentioned,
Yeah.
it highlights the difference between net income and operating cash flow.
The gap between profit on paper and cash in hand.
Exactly. Remember, accrual-based net income includes estimates, judgments, like recording revenue when you earn it, not necessarily when the cash comes in.
Right.
The cash flow statement explains why these two numbers often differ. It helps users gauge the reliability, or you could say the quality, of that reported income.
So it adds context to the net income number.
Absolutely. And finally, it gives invaluable insight into a company's investing and financing transactions.
The big moves.
Yeah, the big strategic stuff. You can quickly see major asset acquisitions, how much debt was issued or maybe paid back if they bought back their own stock. It answers questions like, how much did they splash out on that new factory? Or did they borrow a ton of money last year?
Okay, so it really fills in the gaps left by the other statements.
It really does. It connects the dots.
When I first read about IBM in the source material, their situation really stood out. It said their EPS growth, earnings per share, looked pretty steady.
Which usually looks good on the surface.
Right, but their free cash flow was actually declining. For someone like me trying to understand the real health of a company, that sounds, well, contradictory. What was the red flag there?
Yeah, that's a fascinating case, and it perfectly illustrates why focusing only on net income can be, frankly, misleading.
Okay.
IBM was indeed using that precious free cash flow, the cash left after funding operations and capital expenditures, mainly for increased dividends and share buybacks.
And buybacks boost EPS, right? Fewer shares, same earnings, looks better per share?
Exactly. But the concern among analysts was that this cash wasn't going into vital areas like, say, research and development, future growth engines.
Ah, so it was a question of priorities.
Precisely. To some analysts, it indicated a potential low quality of earnings, meaning the reported profit wasn't necessarily backed by strong, sustainable cash generation from the core business. And importantly, it reduced IBM's financial flexibility for future innovation and investment.
Wow, okay. That really drives home the point.
It really shows you that cash, not just reported profit, is, well, maybe not king, but certainly crucial.
So, understanding how these cash flows are categorized seems absolutely fundamental then. Let's break down those three types you mentioned: operating, investing, financing.
Absolutely. Let's start with operating activities. These are the cash flows generated from a company's day-to-day core business operations.
The main engine.
Exactly. The transactions that ultimately determine net income. Think of these as the economic heartbeat of the business.
Okay. What are some typical examples?
Well, typical cash inflows here would include money from selling goods or services, interest revenue received on notes, or dividends received from equity investments someone else issued.
Got it. And outflows.
On the outflow side, you'll see cash paid to suppliers for inventory, to employees for their services, to the government for taxes, to lenders for interest expense, and, for other general operating expenses.
Pretty straightforward.
Mostly, but here's a crucial nuance, a common point of confusion. Even if interest or dividends received relate to an investing activity, or interest paid relates to a financing activity.
Mm.
If those items pass through the income statement as revenue or expense,
Which they usually do.
right, then their cash flows are classified as operating activities under U.S. GAAP. That's key. The income statement impact drives the cash flow classification here.
That distinction is really important. Thinking about these categories, it truly paints a picture of a company's strategy, doesn't it?
It really does.
You can almost see their priorities just by looking at how they're managing these three streams of cash. Can you give us a sense of how these patterns might shift, maybe through a company's life cycle?
That's a great point. You absolutely can link these cash flow patterns to a company's stage in the product life cycle. It's quite insightful.
How so?
Well, think about the introductory phase. A new company, a new product,
Yeah.
they might have negative operating cash flow. Why? Because they're investing heavily in building the business, marketing, R&D, and maybe not generating much revenue yet.
Makes sense. Lots of spending up front.
Right. And you'd likely also see negative investing cash flow as they're buying equipment, building facilities, maybe developing patents.
So where's the money coming from?
Good question. To fund all this, they'd likely have strong, positive financing cash flow. They're raising capital, issuing stock, taking on debt.
Okay, that paints a picture. The source used Netflix as an example, right? Back around 2018.
Exactly. Perfect example. They were pouring billions into creating original streaming content. Huge investment.
So their numbers showed.
Negative operating cash flow, negative investing cash flow.
Hmm.
But a whopping, I think it was around $4 billion in cash inflows from financing activities. Issuing debt, mainly.
Which makes total sense for a company in that heavy growth and investment stage.
Absolutely. But then, as that content, their product, moved into the growth and maturity phases, what happened?
Their operating cash flow turned positive.
Significantly positive by 2020. Exactly. The content started generating substantial subscription revenue. So, like you said earlier, a negative operating cash flow isn't automatically bad. Context is everything. Depends entirely on where the company is in its life cycle.
Fascinating. Okay, so that covers operating. What about the other two? Investing.
Right. Second category, investing activities. These are cash flows related to changes in a company's long-term assets and other investments.
Buying and selling the big stuff.
Pretty much. Cash coming in here would be from selling property, plant, and equipment, PP&E, or selling off debt or equity investments they held in other companies, or maybe collecting the principal portion of loans they made to others.
In cash going out.
Cash going out would be things like buying new equipment for the factory, purchasing investments in other companies' stocks or bonds, or making loans to other entities. Basically investing in the company's future or in other entities.
Got it. And the third one, financing.
Finally, financing activities. These involve cash flows from changes in long-term liabilities and stockholders' equity. How the company funds itself, essentially beyond operations.
So getting money from owners or lenders.
Exactly. Inflows here come from selling the company's own stock, common or preferred, or issuing debt like bonds or notes payable, taking out loans.
And outflows, paying them back.
Right, paying dividends to stockholders, paying off the principal on long-term debt, or repurchasing the company's own common stock, often called treasury stock.
Okay. And you mentioned something about gross reporting.
Ah, yes. For both investing and financing activities, companies generally use gross reporting. That just means individual inflows and outflows are reported separately. They don't just show the net change.
So you see the actual purchase of equipment and the actual sale of old equipment, not just the difference.
Exactly. Gives you more detail on the specific activities.
Okay. Now, for anyone listening who might be thinking, this sounds complicated to put together, how do companies actually prepare this statement? It's clearly not as simple as just pulling numbers from a basic trial balance.
No, it definitely takes a bit more work. Companies typically rely on three main sources of information.
Which are?
One, comparative balance sheets. You need last year's and this year's to see the changes in assets, liabilities, and equity accounts.
Okay, makes sense. Chain analysis.
Two, the current income statement. That gives you net income and information about revenues and expenses, including non-cash items like depreciation.
Right, the starting point for operating, often.
And three, selected transaction data from the general ledger. You sometimes need the nitty-gritty details for specific investing and financing activities, like the exact cash received from selling a piece of land.
Okay, so you gather all that data, then what?
Once you have the data, the process generally involves three major steps. Step one, determine the total change in cash from the beginning to the end of the period. That's your target number, the bottom line of the statement.
Got it. Check figure.
Step two, figure out the net cash flow from operating activities. This is usually the most complex part, as we'll see.
Okay.
And step three, determine the net cash flows from investing activities and financing activities. These are often a bit more straightforward, involving analyzing changes in the related balance sheet accounts and the transaction data.
All right, so that operating section, you said it's the most complex. There are two ways to do it.
That's right. For that crucial operating activity section, companies have two methods allowed under GAAP: the indirect method and the direct method.
Let's start with the common one, indirect.
Okay. The indirect method is, by far, the most common in practice. You see it almost everywhere.
Why is that?
We'll get to that.
Yeah.
But how it works is, it starts with accrual basis net income, the profit number we're used to seeing on the income statement.
Okay, starting point, net income.
Right. And then it adjusts that number. The goal is to reconcile net income back to actual cash flow from operations. So we add back any non-cash expenses that reduced net income but didn't use cash.
Like depreciation.
Depreciation is the classic example. Amortization of intangibles, too. Also, losses on sales of assets are added back. And we deduct any non-cash revenues or gains, like a gain on sale of equipment.
So adjusting for things that hit the income statement but not the cash account.
Exactly. And then we also adjust for changes in the current operating asset and liability accounts, the working capital accounts.
Accounts receivable, inventory, payables.
Precisely. For example, if accounts receivable increased during the year, it means you recognized more revenue than cash you collected. So you have to deduct that increase from net income to get to cash flow.
Okay, because the cash isn't in yet.
Right. Conversely, if accounts payable increased, it means you incurred more expenses than cash you paid out to suppliers. So you add that increase back to net income.
It's like a reconciliation, step by step.
That's exactly what it is, a reconciliation from accrual net income to cash flow from operations.
Now that Kraft Heinz example you mentioned from the source, that sounds like a really interesting illustration of how these adjustments work, or maybe how they can be managed.
It is. It's a fascinating reminder that even cash flow, which seems so concrete, isn't entirely immune to accounting choices and presentation.
What happened there?
Well, the source points out how Kraft Heinz made some changes in how they handled things like the securitization of receivables, basically selling their receivables to get cash faster. Reclassifying items related to these programs significantly boosted their reported operating cash flow.
Ah, so moving things around between categories, potentially.
Essentially, yes. It highlights that while we often say cash is cash, how it gets classified, operating, investing, financing matters a lot for analysis. It underscores that even with the cash flow statement, a savvy analyst needs to dig deeper.
So you can't just take that operating cash flow number at face value always.
You shouldn't. You need to look at the quality of that cash flow. Are they generating it sustainably from core operations? Or are they using techniques like aggressively managing working capital or securitizations that might not be repeatable? You'd want to cross-reference with other metrics like accounts receivable, turnover, inventory levels, things like that.
It's not always as clean-cut as it looks, is it?
Rarely is in finance. That Kraft-Heinz case just emphasizes that understanding how the numbers are put together is just as vital as the numbers themselves. Always look at the underlying trends.
Good advice. Okay, so that's the indirect method. What about the other one, the direct method?
Right, the directs method. Now, interestingly, this method is actually preferred, or at least encouraged, by the FASB, the Financial Accounting Standards Board.
But you said it's less used.
Much less used in practice, yes. The direct method conceptually is maybe more intuitive. It directly reports the major classes of actual cash receipts and cash disbursements from operations.
So instead of starting with net income and adjusting, it just lists the cash coming in and going out.
Exactly. It would show things like cash collected from customers, then maybe cash received from interest and dividends, then cash paid to suppliers, cash paid to employees, cash paid for operating expenses, cash paid for interest, cash paid for income taxes, and sums those up to get net cash flow from operations.
That does sound more straightforward. Why isn't it used more?
The main reasons companies cite are the cost and complexity. Their accounting systems often aren't set up to easily track cash inflows and outflows in that specific detail needed for the direct method report. Gathering that data can be burdensome.
So the indirect method is easier because it uses data already available from the income statement and balance sheet.
Pretty much, yeah. It leverages the existing accrual accounting system. Now, there's a key rule here. If a company does choose to use the direct method,
Yes.
they must also provide a separate schedule that reconciles net income to net cash provided by operating activities.
Which is basically the indirect method anyway.
Exactly. So you end up having to do the work for both methods, in a sense, if you choose the direct method for the main presentation. That's another disincentive for many companies.
Okay. That makes sense why they stick with indirect. So what does this all mean for you, the person reading the financial statements?
Well, it means understanding both methods is really crucial, even if you mostly encounter the indirect method.
Why? If indirect is the standard.
Because knowing how the direct method would work helps you appreciate why all those adjustments are being made in the indirect method. It gives you a deeper conceptual understanding of what the indirect method is trying to achieve, bridging that gap between accrual profit and actual cash.
So it helps interpret the indirect method better.
Definitely. It helps you analyze those adjustments more critically and gives you a better insight into the true cash generation power of the business. It's not just about the final number, the net cash from operations, but how the company got there.
Okay, that's clear. Now, beyond the two methods, are there other tricky areas, special problems or nuances we should be aware of?
Oh, absolutely. Preparing and interpreting the statement definitely has its complexities.
Like what?
Well, we touched on adjustments like depreciation, but think about gains and losses on asset sales, like selling equipment or land.
Okay.
Let's say a company sells equipment for $10,000 cash, and it had a book value of $8,000.
Okay.
That's a $2,000 gain, right? That gain increases net income. But the entire $10,000 cash inflow belongs in the investing section because it's proceeds from selling PP&E.
So you don't want to count it twice.
Exactly.
Right.
So in the operating section, using the indirect method, you have to deduct the $2,000 gain from net income. Conversely, if there was a loss on the sale, you'd add back the loss. It removes the non-operating gain loss, so the full cash proceeds land solely in investing.
Got it. That prevents double counting. What else?
Things like equity method income. If a company owns, say, 30% of another company, or Porter Company in the textbook example, its share of Porter's net income increases its own net income.
Okay.
But unless Porter actually pays out that income as dividends, the investor company hasn't received any cash. So that non-cash portion of the equity method income needs to be deducted from net income in the operating section.
Again, backing out the non-cash stuff.
Always the theme with the indirect method. Same idea with stock compensation expense. It reduces net income, but no cash changes hands when the expense is recorded. So you add it back to the operating section.
Makes sense. What about unusual items, like, say, the government forces you to sell land? Condemnation.
Good question. Let's say you get cash proceeds from a land condemnation. That cash inflow itself is typically classified as an investing activity proceeds from disposal of PP&E.
Okay.
But any gain or loss calculated on that condemnation would have hit net income. So just like regular gains or losses on asset sales, you'd need to adjust for that gain or loss in the operating section, indirect method, to avoid double counting.
And income taxes. Where do they always go?
Under U.S. GAAP, all income taxes paid are classified as operating cash outflows, regardless of whether the tax relates to operating income, gains on asset sales, investing, or anything else. That's a strict rule.
Good to know. Okay, one more clarification. What about companies with a net loss? Can they still have positive operating cash flow?
Absolutely. It sounds counterintuitive, but yes, a company can report a net loss on its income statement, but still generate positive cash flow from operations. If its non-cash expenses, primarily depreciation and amortization, are larger than the net loss. Think about it. Net loss means expenses exceeded revenues. But if a large chunk of those expenses didn't actually require a cash outlay during the period,
Like depreciation.
then the cash generated from revenues or collected from prior revenues could still be more than the cash paid out for other expenses. So yes, positive operating cash flow despite a net loss is definitely possible.
Okay. And what about significant things that happen without any cash changing hands, like acquiring a building by taking on a mortgage?
Great point. Those are called significant non-cash investing and financing activities. They're important transactions, but they don't involve cash directly.
Examples.
Acquiring assets by assuming liabilities, like taking out a mortgage to buy a building or entering into a capital lease. Exchanging one non-monetary asset for another, like trading land for equipment. Converting bonds, payable, or preferred stock into common stock. Issuing stock to acquire assets.
So these are important for understanding the company's changes, but they don't go in the main body of the cash flow statement.
Exactly, because no cash moved. They are disclosed separately, either in a narrative note or in a schedule right at the bottom of the statement of cash flows. You need that info for a complete picture, but it's kept separate from the cash movements.
Okay. And just briefly, the source mentions using a worksheet. Is that common?
Ah, the worksheet. It's an optional tool mostly used internally by accountants when preparing the statement, especially if there are many complex adjustments. It's basically a spreadsheet grid that helps organize the data from the balance sheet changes and income statement, classify items, and ensure everything reconciles properly before drafting the formal statement.
So helpful for the preparer, but not something you'd usually see published.
Generally not, no. It's a behind-the-scenes tool.
Got it. Before we wrap up, you touched on GAAP. Any major differences if we're looking at international standards, IFRS?
Yes, there are a few key differences between IFRS and GAAP regarding cash flows, though the overall structure is similar.
Okay. Similarities first.
Both require a statement of cash flows. Both use the three sections: operating, investing, financing. Both allow either the direct or indirect method for operating activities. Definitions of cash equivalents are pretty similar too.
Okay. Differences.
One difference is bank overdrafts. Under IFRS, overdrafts can sometimes be considered part of cash and cash equivalents if they're integral to cash management. Under GAAP, they're usually treated as financing activities, short-term borrowing.
Interesting. Anything else?
The big one is classification flexibility under IFRS. We said under GAAP, interest paid and interest dividends received are always operating, and dividends paid are always financing.
Right. Strict rules.
IFRS offers more choice. Interest and dividends received can be classified as either operating or investing. Interest paid can be operating or financing. And dividends paid can be operating or financing, though financing is more common. Companies just need to be consistent.
Wow. So the same company could report different operating cash flow under IFRS versus GAAP just based on these classification choices.
Absolutely. It can make direct comparisons a bit trickier sometimes. Also, IFRS requires those significant non-cash transactions to be disclosed in the notes, whereas GAAP allows them in the notes or a separate schedule. Minor difference there. And IFRS generally requires taxes paid to be disclosed separately, potentially split if they relate to different activities, whereas GAAP lumps them into operating.
Okay. Good nuances to be aware of if you're looking at global companies.
Definitely.
So as we bring this deep dive to a close then, let's circle back. Remember that initial mystery we talked about why a company's net income doesn't always line up perfectly with its actual cash?
Mm-hmm.
Well, hopefully this deep dive has shown you how the statement of cash flows really unravels that. It lets you move beyond just looking at that reported profit number.
Which is important but incomplete.
To truly understand the full financial story, cash is, if not king, then definitely critical, right? And this statement shows you exactly where it's coming from, where it's going. It offers a much clearer picture of liquidity, solvency, and that real financial flexibility.
It really does connect the balance sheet and income statement over time, showing the cash impact of everything the company does. It's indispensable.
So here's a final thought to leave you with.
Okay.
This raises an important question. Considering everything we've unpacked about the sources and uses of cash, the classifications, the adjustments, what hidden stories might you uncover about the companies you interact with every day? Big tech firms, your local coffee shop, whatever, if you looked beyond their reported profits and really dug into their cash flows?
That's a great question to ponder. Where is the cash really going?
Thank you so much for joining us on this deep dive into the statement of cash flows. Until next time, keep digging for those nuggets of knowledge.